Welcome to Bitunix Futures, where we prioritize the safety and security of our traders. Today, we're going to explore two critical aspects of our platform: the tiered risk limit and liquidation mechanism. At Bitunix Futures, we understand the importance of minimizing forced liquidations of large positions while empowering users with higher trading limits. That's why we've implemented a tiered risk limit for all futures trading. It's important to note that risk limit tiers vary for each cryptocurrency, ensuring tailored risk management strategies. Currently, we have displayed the risk limit tiers for BTC. Let's delve into tiered risk limit. This system categorizes trading risk into different tiers, each defined by factors such as tiers, nominal value, max leverage, and maintenance margin rate. Think of it as a protective shield, shielding you from unnecessary risk. For instance, when trading BTC perpetual contracts with a leverage of 50x, your risk limit tier would be 3, with a maximum value of 2,500,000 USDT. Now, onto the liquidation mechanism. This system kicks into action when a user's position is triggered for forced liquidation. It begins by withdrawing the user's current order to release margin. If forced liquidation persists, the position is partially closed to lower the risk limit, safeguarding the user's position. In cross-margin mode, all open positions are collectively evaluated. If any one position exceeds Tier 1 risk limits, it undergoes reduction based on priority criteria such as risk limit tiers, release of maintenance margin, and nominal values. Conversely, isolated margin mode evaluates individual positions, cascading position reduction individually if the risk limit tier exceeds 1. During liquidation, the system checks if the user's position is at any risk limit tier. In scenarios where the risk limit tier is at Tier 1 or higher, the system attempts to lower it initially. If it persists, the position undergoes partial closure through a fill or kill (FOC) order. Now, let's explore the scenario of liquidations through the eyes of Sarah, one of our traders. If Sarah's risk limit tier is already at the lowest tier, Tier 1, the system takes immediate action.
It cancels all open orders to release additional margins, sparing no effort to save her position.
However, if her position still doesn't meet the maintenance margin rate requirement, it will sadly be liquidated. Now, let's say Sarah's risk limit tier is at the second tier or higher. In this case, the system first cancels all open orders to release additional margin, giving Sarah a fighting chance to adjust her position. It then initiates efforts to lower the risk limit tier, aiming to decrease the necessary maintenance margin rate. If these steps don't reduce the risk enough, the system continues to lower her position step by step until it either reaches a stable level or is completely liquidated. For example, if Sarah holds a position valued at 5 million USDT with a risk limit tier of 4, and liquidation occurs, the system will take action. It will reduce her position to lower the risk limit to level 3, ensuring to protect her investment. After this adjustment, Sarah's risk limit moves to Tier 3, and the maintenance margin rate is updated. Her position then returns to normal. When the system takes action, it will always start with canceling all orders to release margins first. The maximum value for Tier 3 is 2,500,000 USDT, so after the reduction, the position of her value will be at 2,500,000 USDT after the deduction of the needed value, 2,500,000. Understanding these processes is vital for Sarah's success as a trader. Understanding these mechanisms is crucial for effective risk management and successful trading. We encourage you to explore Bitunix Futures platform further to discover more tools and resources for your trading journey. Thank you for joining us today, and happy trading!